Runaway inflation is threatening to derail global economies. The US just recorded 7.5% annual inflation for the 12 months ending January 22. This is the fastest rate growth of inflation that's been seen for 40 years since 1982. And it's got world markets very scared because out of control inflation can actually destroy currencies and economies as well. And it's also painted the Federal Reserve into a very tight corner. This is the same Fed who kept telling us that inflation was only transitory and would be fixed up once global supply issues are resolved. So runaway inflation is a major issue and it threatens popping the stock market and real estate bubbles that ultra loose monetary policy helped to create. Just imagine this is a bubble popping. I'm Biko Konstantinos and that's what we're going to talk about today. Please do me a favor and give this video a like, as that will help YouTube spread my videos to a wider audience. And please consider subscribing to my channel, as my goal is to support you with quality and up-to-date financial information. Now let's see what this pesky inflation has been up to and what it can mean for the stock market, for housing, and the global economy in general. To delve into what's actually happened, we're going to have a look at this article from Associated Press. Consumer prices jumped 7.5% for the 12 months leading up to January 2022, which is the steepest year-on-year increase since February 1982. Some of the reasons cited for this sharp increase in inflation is shortages of supplies and workers, heavy doses of federal aid, ultra-low interest rates, and robust consumer spending combined to send inflation accelerating over the past year. So we've got very strong inflation rising occurring in the US with little sign to show that this is actually going to stop or slow down. And that's what I think's got everybody worried, because it looks like we're in this high level inflation environment and it doesn't look like it's just going to end next month or the month after. Sure, it might ease, but most people think that won't occur until maybe 12 months or 24 months down the track. This has definitely caught the Fed off guard, and it feels like they might need to play some catch up, because initially their guidance was they were not going to raise rates in a hurry because they felt that inflation was only transitory, which meant they felt that after the supply issues and things like that are fixed, then inflation would just automatically come straight down. Now, the point I've heard a lot of commentators make is once prices are risen, there's no way businesses or companies are going to bring them right back down straight away. It's very likely that those risen prices are actually here to stay, and we won't actually see lower prices even if supply issues and other issues have been sorted out. The Fed Chair Jerome Powell signaled 2 weeks ago that the central bank would likely raise its benchmark short-term rate multiple times this year, with the first hike almost surely coming in March. Investors have currently priced in at least 5 interest rate rises in 2022. Now, 5 interest rate rises at 0.25% is only 1.25%, but when we've seen interest rates drop for many years now, and we were also given the expectation that they're going to remain ultra low for an extended period, it will be quite a shock to the investing community. It will mean businesses and companies will have to pay more on all their borrowings. Mortgage repayments will cost more on a variable rate. New home buyers will not be able to borrow as much money. So generally, higher interest rates normally would lead to lower spending because more money is spent on repayments of debt. And that's why it's the chief tool that's used to try to curb inflation. Now, once inflation gains momentum, it can be quite difficult to stop. For example, small businesses and companies have to pay more for the supplies that they use, and for them to maintain their profit margins, they'll need to charge more to the customers for the products that they supply. Many fast food chains are raising their menu prices because it's costing more to supply goods and it's taking longer. Many businesses are passing those increased costs onto customers as well. And when these products are necessities, well then people just have to buy them. There's no really not buying certain things. When it comes to petrol or gas for your car, if you're wanting or needing to travel around, you've got no other option but to pay those higher prices. But if prices continue to rise, a lot of consumers may not be able to buy as many of the goods and services that they previously did, and this can result in the economy falling into a recession. So that's a real concern for the US and for many other countries at the moment as they try to deal with these sharp increases in inflation. I'm going to go through some thoughts from this Financial Review article, which was published on February the 11th, 2022. According to this article, the January rise of 0.6% was a surprise as most economists were only expecting a 0.4% rise. This increases the odds of a 50 basis point increase at the March meeting. The Fed board member James Bullard suggested that potentially 100 basis points worth of hikes were required by July the 1st, 2022. Now, if this is the case, it's quite significant and it's actually quite aggressive compared what the whole market was expecting maybe only 3 or 4 months ago. And that's why everyone's suddenly talking about inflation. That's why everyone's worried and a bit of fear is coming in, especially from the high net wealth type investment area. I've heard of a number of investors taking some money out of the stock market because they're worried about the effects of this aggressive pivot for both the Fed and for around the world as countries grapple to tame runaway inflation. There's also a political factor to very high inflation, because if everyone's purchasing power is eroded, or put another way, everyone has to pay way more for all their daily goods and services, then the people aren't going to be happy. They'll blame the government in charge, and that's why President Biden is really trying to take this seriously. On Thursday, the White House released a statement calling this week Prices Week and outlined what is called a comprehensive strategy to lower costs for working families. President Biden said that his administration would be all hands on deck to win this fight. So you can see by statements like that there is a large political ramification for runaway inflation if it's not controlled. And this will be especially the case in the US, where midterms are coming up. Now, the US Fed is in a very, very difficult position. On the one hand, they can't afford for inflation to get out of control or even to keep rising too much, because we've seen some examples in other countries where runaway inflation can seriously deteriorate a currency for a country. It can also send economies into recession because people will have less and less real money to spend. But on the other hand, the US national debt has just broken above $30 trillion. As staggering as that figure is, the real increase to this national debt has occurred in the last 2 years. So if interest rates rise too high, it will result in an exponential increase to the repayments that the US have to make to service that debt. Raise interest rates too high and it'll cripple the entire country. Okay, so there's no doubt that interest rates are going to rise. This has probably spelt the end of the multi-decade period of lower interest rates. So what is this going to mean for assets? I think everyone can agree housing has gone ballistic over the past 2 years or year and a half, and a massive factor of these house price rises was due to the ultra low interest rates, where you could actually borrow huge amounts of money, but the service on those loans was quite low. But this is now going to change. And how much is that going to affect the housing market? Well, I think there's no doubt that it'll affect the market, because people already with any type of loans are going to have to pay more. And it also means that people looking to buy a house will not have as much borrowing power, because as interest rates rise, the amount that the banks will lend them will be reduced. That means if a first homeowner originally was able to borrow $1 million, if interest rates are increased by 100 or 200 basis points over the next year or two, then they might suddenly find themselves only being offered maybe $900,000 or $850,000. So that'll have a large effect on what new home buyers can purchase a house for, which means that they might not be able to meet the seller's asking price. And if enough people can't meet that asking price, then the prices might have to come down to meet what buyers can afford. Now, another big thing for the housing market will just be the emotion of the market. We've seen crazy demand. We've seen a fear of missing out type mentality where everyone's trying to outbid others just so that they can get in because they're worried that prices will keep going up. We've seen widespread speculation. So whenever an asset class rises really fast, all eyes are drawn to that asset class and it brings more people in. So all those emotions in the market can signal a bubble. So whether or not housing is in a bubble will be hard to know right now. But if we see some drastic falls in the future, then we might be able to look back and say, yes, it definitely was a bubble. Either way you look at it, interest rate rises will definitely affect the housing market. Now, the amount that it does affect the market will be based on how aggressively or how fast interest rates are risen. If they have to rise them very fast and aggressively to try and curb out of control inflation, then we could see some quite drastic falls in the housing market ahead, but that could take some time to eventuate because you've still got strong demand. So that will most likely start to fade out slowly. Then you might start to see some small falls, and that could then grow a little bit of momentum as fear enters the market. I would personally keep a watch out for the media, and when you start seeing headlines that discuss 10% falls or 15% falls, then you know that fear is starting to enter the market. Now, the stock market is also primed for a potential fall. If you check out this video here, we've seen some recent rises in the stock market, but that could have been just a bull trap. It could have been the last hurrah before we really start to see prices deteriorate. I also made this other video which talked about how expensive the stock market is relative to the average mean, which means that it could fall a very long way before it actually gets back to that average expense valuation type ratios. So globally, we've seen massive stimulus, we've seen ultra loose monetary policy, and as a result, we've seen some real bubble type behavior in the stock market, in housing, in the crypto market. And I think that's the biggest worry going forward, because maybe that buying and that excess and that speculation just got out of control. So we might be in for some real pain ahead. Just be watchful for the mood of the market. If you've always had the mentality of buy the dip, that's fine if you're doing a long-term strategy and just trying to increase your shares in the market, etc. But just be aware that if real fear and panic enters the market, whether it be housing or the stock market, then prices of assets can actually fall dramatically. And I would just consider that in the back of your mind, because we've seen amazing returns, amazing rises, and there is the potential for amazing falls ahead as well. Hey, I'd really love to hear your thoughts regarding inflation, regarding interest rates, and how much they might have to rise to curb inflation, and also regarding the market. So the effect that interest rates will have on the housing market, the stock market, and anything else in general. I'm Biko Konstantinos. Thanks so much for watching. Please subscribe to my channel for similar content, and I'll catch you in my next video.